Hello and welcome back to the deep dive. It is Thursday, February 19th, 2026, and I am honestly thrilled you're joining us today because, well, we have quite a story to unravel.
Yeah, we really do.
It involves a massive financial turnaround, a bit of currency magic, and a look at the future of energy. But before we get into the heavy-hitting numbers, I have to acknowledge the date.
Right. It is a very special week in the calendar.
It really is. We are right in the middle of this rare and beautiful convergence. So, to all our listeners celebrating, I want to wish you a very happy Chinese New Year.
Absolutely.
And to our Muslim listeners, a blessed happy Ramadan. It's not often these massive cultural moments overlap quite like this, so the energy out there is just, it's unique right now.
It is. It's a great time for reflection and, honestly, a great time to look at where we stand as we move deeper into 2026.
Exactly. And speaking of looking at where we stand, if you are getting value from these deep dives, I have a tiny favor to ask. Take literally 1 second right now to click like and hit subscribe on the YouTube channel.
It makes a huge difference.
It really does. It helps the algorithm get these insights to more curious minds like yours, and it just helps us keep the lights on here at the studio.
We genuinely appreciate the support.
All right, let's get down to business. Today, we are dissecting the latest financial update from Dialog Group. Specifically, we're looking at the Q2 FY2026 report, which covers the period that ended December 31st, 2025.
And for anyone who's been tracking Malaysian oil and gas, or really just following our show for the last year, this is the report everyone has been waiting for.
It feels like the season finale of a very stressful drama series.
Yeah.
We have been tracking this saga so closely. I mean, just a few months ago, we did that deep dive on Q1 FY 2026. You might remember the title. It was the 175% operational boom hiding a critical foreign exchange problem.
Right. That was a really weird quarter.
Yeah.
The operations were booming, but the currency markets just absolutely crushed them.
And before that, this was exactly 1 year ago, we covered the absolute shocker Q2 FY 2025. We titled that one, Dialog Group's Latest Results, First Loss in 25 Years.
Yeah, that was a dark, dark day for the stock and for the shareholders, obviously.
A massive panic.
That was the bottom. Historically, that was the low point. And I think that sets the stage for our mission today. We aren't just reading numbers here. We are trying to answer one specific question.
Right. Is the recovery real?
Exactly. We have to compare the disaster of exactly 1 year ago to this new report to see if the ship has actually turned around or if they've, just painted over the rust.
So let's not bury the lead here. We need the damage report versus the recovery report. Give us the headline numbers. What is the difference between today and the disaster quarter from last year?
The contrast couldn't be sharper. If you look at Q2 FY 2025, they posted a net loss of RM 125.6 million.
Ouch.
It was ugly. It was the first time in a generation they were in the red.
I remember the panic. People were legit asking if the business model was fundamentally broken.
But fast forward to today, Q2 FY 2026.
Right.
They have posted a net profit of RM 150.9 million.
Wow. Okay, so from minus 125 to plus 150. That is a massive swing. You're talking about a turnaround of over RM 275 million in raw value in just 12 months.
It's a complete reversal. And the top line supports it too. Revenue is up 11.2% year-on-year to RM 756.3 million.
Okay.
And maybe even more impressively, it is up 15.1% quarter-on-quarter. So compared to just 3 months ago, business is accelerating.
Okay, so on the surface, the patient has recovered. The numbers are totally green. But I have to play the skeptic here, as always.
Please do.
We don't just accept the headline number. We have to ask why. What changed so drastically in 12 months to go from a historic loss to a really solid profit? Did they find gold under the storage tanks?
Not exactly. To understand that, you have to remember a concept we discussed in that first loss episode, the kitchen sinking.
Right, the kitchen sink.
Yeah.
For the listeners who might be new to that term or who join us after that deep dive, can you just break down kitchen sinking again?
Sure. Kitchen sinking is a strategy that companies use when they have a disastrous quarter.
Right.
They realize they're going to miss their targets anyway, so they take all their bad news, every bad debt, every failed investment, every cost overrun, and they write it all off at once.
So they throw everything but the kitchen sink into that one quarter.
Precisely. You make one quarter look absolutely terrible so that the future quarters look clean by comparison. You just take the pain all at once.
Got it. So last year, that RM 125 million loss was driven by those massive one-off impairments.
Right. They wrote off failed investments in petrochemicals. They dealt with cost overruns in their construction arm. They essentially scrub the books clean.
And now, 12 months later, we're seeing the benefit of that deep clean.
Exactly. This quarter, those impairments are gone. You aren't seeing those massive anchors dragging down the profit. So a significant part of this year-on-year recovery is simply the absence of last year's disaster.
Okay, so the absence of bad news is good news. But surely they can't just stop losing money to generate $150 million in profit.
No, no.
I mean, they have to actually be making money, too. You can't just cut your way to growth.
You are exactly right. And that brings us to the engine room of the company, the actual operations. We need to look at the health of the business segments.
Let's break it down by their three main pillars, right? Midstream, upstream, and downstream.
Let's do it.
Let's start with midstream. We always call the tank terminals their safety net. Is the net holding?
The net is essentially bulletproof right now. The Malaysian midstream operations, specifically the tank terminals in Pengerang and Tanjung Langsat, they are performing exceptionally well.
I was actually reading through the analyst reports in our source stack for this deep dive, and one phrase just kept popping up. They said the assets are filled to the brim.
That is a very accurate description.
Yeah.
We're seeing very high occupancy rates, but it's not just about volume, it's about pricing. Storage rates, the daily tariff they charge to store oil, are ticking upward.
Oh, interesting. Why is that? Is there a shortage of tanks?
Well, there is tight supply for storage in Asia right now, yes. But also look at the geopolitical situation. When there is uncertainty in the Middle East or shipping lanes get disrupted, countries and companies want to stockpile energy. They want a buffer.
That makes sense.
And Pengerang sits right on one of the busiest shipping lanes in the world. It is prime real estate for that buffer.
So Dialog is benefiting from high volume and better pricing.
Exactly.
That explains why 13 out of 14 research houses now have a buy call on the stock. That's a huge shift in sentiment from a year ago.
It really is. The market loves stability. And right now, the midstream segment is just printing cash. But we need to be careful, because midstream is only one leg of the stool.
Right. Let's talk about the wobbly leg then, downstream. This is the engineering, construction, and maintenance arm, the EPCC. This is where the cost overruns killed them last year. Has the bleeding stopped?
It appears so. The report is actually quite specific here. It mentions that downstream operations achieved higher contributions due to cost optimization and, crucially, the completion of projects.
Completion of projects. That sounds like corporate speak for, we finally finished those nightmare contracts.
That is exactly what it means. During the pandemic and the inflation spike afterward, Dialog got stuck in some fixed-price contracts.
Oof.
Yeah, material costs went up, labor costs went up, but their revenue was locked in. They were literally losing money on every hour they worked.
And now those are done.
They're mostly off the books. And, more importantly, their strategy has fundamentally changed. They're being incredibly selective about what they bid for now.
Right. They learned their lesson.
Exactly. They are prioritizing in-house projects, like building their own terminals, rather than taking on risky external contracts where they just have less control.
That is a relief. So midstream is booming, downstream is fixed. What about upstream? This is the actual drilling and production of oil. Drill, baby, drill.
Upstream is fine. It's sort of the C student in the class right now.
Okay.
It is profitable, but interestingly, it's contributing less than it did last year.
Really? Why is that? If oil prices are decent, shouldn't they be making more?
Well, there are two headwinds here. First, reduced crude oil allocations. That just means they are physically pumping less volume out of the ground.
Right.
Second, lower realized oil prices compared to the same period last year.
Wait, let's unpack realized oil price really quick. Is that different from the Brent crude price I see on the news ticker every morning?
It's related, but not identical.
Yeah.
The realized price is what they actually sell their specific barrel for after hedging and quality adjustments. So even if the global price is high, their realized price dropped year on year.
Got it. So lower volume times lower price equals lower margin.
Exactly. But is it still positive? Yes. It's not dragging the group down, but it isn't the big growth driver right now either.
Okay, so let's summarize the operational side. Midstream is the hero, downstream has stopped bleeding, and upstream is stable but quiet.
That's a very fair assessment of the operations.
However, and there is always a however with Dialog lately, we need to talk about our recurring villain, or I guess in this episode, perhaps an anti-hero.
You mean the foreign exchange?
The FX.
The FX.
Yes. In our last deep dive, specifically that Q1 FY2026 one, we saw how currency fluctuations just ate up all their hard work. The operations were up 175%, but the bottom line didn't show it. Did the currency markets hurt them again this quarter?
Well, here is where it gets really interesting. This is the plot twist.
Okay.
In Q2 FY 2026, FX wasn't the villain. It was actually the hero. In fact, it's the main reason the profit number looks so spectacular.
Really? How much of an impact are we talking about?
Let's look at the joint ventures. Dialog operates its biggest assets, the Pengerang terminals, through joint ventures or JVs. In the report, look at the line item. Share of profit from joint ventures and associates.
Okay, I'm looking at it. In Q2 of last year, it was RM 7.6 million. That's tiny.
Right. Now look at this quarter.
RM 76.4 million. Whoa! That is a tenfold increase.
It is a 10x jump. But, and this is the biggest expert insight warning label of the deep dive, that jump is not entirely due to selling more oil storage.
Okay.
A massive chunk of that is due to favorable foreign exchange movement.
Okay, we need to ELI 5 this. Explain, like, I'm 5. How does a currency change create a 70 million ringgit profit out of thin air?
It all comes down to debt.
Yeah.
These joint ventures borrowed a lot of money to build the terminals, right? And they borrowed it in US dollars.
Okay, so they owe USD.
Right. But their reporting currency is the Malaysian ringgit. When the ringgit strengthens against the US dollar, which it did significantly during this period, the value of that USD debt, when converted back to ringgit, goes down.
Oh, so on paper, they just owe less money.
Exactly. If you owe $100 million and the exchange rate moves from 4.5 to 4.3, suddenly you owe significantly less in ringgit terms. Accounting rules dictate you have to book that savings as a profit.
That's wild.
It's called an unrealized gain on foreign exchange.
Unrealized being the key word there.
Crucial word. It's a paper gain. It makes the P&L statement look fantastic, but it doesn't mean there's an extra RM 50 million in cash sitting in the bank account that they can go spend on dividends or salaries.
This is such an important distinction for you listening. We see the headline, profit jumps to RM 150 million, and we think the company is just flush with cash. But a big slice of that is just accounting math based on the currency rate that specific day.
Precisely. And if the ringgit weakens next quarter, that profit could turn into a loss just as fast. It's currency roulette.
So if I strip away the luck, if I take away the FX gain, is the business still doing well?
It is doing well, yes.
Yeah.
But not 10 times better. The operational recovery in the tanks is real, the rent checks are real, but the explosive growth in the bottom line is definitely inflated by the currency.
Right.
It's what we call quality of earnings. The earnings are high, but the quality is diluted by that FX volatility.
That is exactly the nuance the average investor misses. They just see the green arrow and hit buy.
Exactly.
Okay, moving away from the balance sheet, let's look at the map. Because geographically, things are shifting too. I noticed in the report that international revenue is actually down. Why is that?
That is a deliberate strategic retreat. It goes back to their strategy of focusing on core competencies. In August 2024, they signed a deal to divest, basically sell off their entire stake in the Jubail supply base in Saudi Arabia.
Oh, right, the Saudi exit. But why leave Saudi Arabia? Isn't that where all the oil is?
It is, but for Dialog, it was a low-margin supply-based business. It wasn't their core strength like the tank terminals are.
Makes sense.
By selling it, they reduce their top-line revenue on paper, but they free up capital and management attention to focus on where they actually win, which is Malaysia.
So they are shrinking internationally to grow domestically.
In a way, yes. They're doubling down on Pengerang. They refer to it as the Pengerang Deepwater Terminals, or PDT.
The crown jewel.
It really is.
Yeah.
They announced the Phase 3 expansion back in November 2025. That is moving forward. But the really exciting growth story, the future-proofing part, is the shift in what they're actually storing.
We are talking about the green transition.
We are. And this isn't just a PowerPoint slide anymore. It's steel and concrete. Look at Dialog Terminals Langsat 3. Phase 1 of that project just started operations in February 2025.
That's effectively right now.
Yes. It's 24,000 cubic meters of storage. And it's not for crude oil. It's for renewable fuel.
Interesting. And I see here in our notes that Phase 2 is even bigger.
Much bigger. Phase 2 is coming online in September 2026. That's 100,000 cubic meters of storage dedicated entirely to a company called Ecoeries.
Ecoeries, that sounds very green. Who are they?
They are a major player in the biorefinery space. They produce sustainable aviation fuel, or SAF, and hydro-treated vegetable oil.
Basically jet fuel made from used cooking oil and waste.
Exactly. So Dialog's pivoting. They are saying, we know oil is the cash cow today, but this renewable stuff is the future.
It's a classic hedging strategy. They're building the infrastructure for the next energy era while still milking the current one. They essentially want to be the landlord for the green energy companies.
That's exactly it.
I love that. Which brings us perfectly to our favorite segment. We need to rate the company's defenses. Based on this Q2 report, the profit recovery, the FX luck, the renewable pivot, what is the verdict on the financial moat scorecard?
We have debated this a lot, looking at the previous quarters. In the last deep dive, we gave them an 8. And despite the volatility, we are holding the score steady. We are giving Dialog Group a financial moat score of 8 out of 10.
Still an 8. That is a very high score.
It is. We classify this as a strong, narrow moat.
Let's unpack that for everyone listening.
Okay.
Why the high score? What gets them the 8?
It is almost entirely driven by the midstream business. That specific part of the company is a 9 or 10 out of 10. Think about the barriers to entry here. To replicate what they have in Pengerang would cost billions of ringgit.
And it's not just money, right? It's geography.
Correct. You need deep water, like 24 meters deep, for the supertankers to dock. You need government approvals, land rights, specialized engineering. You can't just buy a plot of land next door and start a rival terminal. Pengerang is practically a natural monopoly in that specific location.
And the contracts.
The contracts are the cement in the moat. They use take-or-pay agreements.
Can you explain take or pay real quick?
Think of it like a gym membership. You sign a contract to pay RM 200 a month. Whether you go to the gym every day or never step foot in the building, the gym still gets your RM 200.
So the clients, companies like BP or Petronas, they pay for the tank capacity, whether they fill it with oil or leave it completely empty.
Exactly. It guarantees cash flow regardless of whether the oil market is booming or crashing. And some of these contracts, like the one with PT2SB, run for 25 years. That is incredible financial security.
Okay, so that perfectly explains the strong part. Why is it narrow? Why not just a perfect 10?
Because the moat stops at the gate of the terminal. Once you step outside the tank farm into upstream or downstream, the moat just evaporates.
Because downstream is just construction, right? Highly competitive.
Anyone can start an engineering firm. It's a dog-eat-dog world with super thin margins, as we saw with the massive losses last year. And upstream is totally dependent on global oil prices, which Dialog has absolutely zero control over.
And we've seen them fail when they try to leave the castle.
Exactly. Remember the write-offs last year? They tried to get into recycled plastics, the RPET stuff, and specialty chemicals. It didn't work. They lost money and had to write it off.
Right.
That proves that they don't have a competitive advantage in manufacturing. They have a competitive advantage in infrastructure.
That concentration risk is exactly why we cap them at an 8. If the midstream business ever falters, the rest of the company just can't hold up the sky.
That's a perfect summary.
So let's wrap this up. We have covered a ton of ground today.
We really have.
Summary time. The kitchen sinking is officially over. That first loss in 25 years is safely in the rearview mirror. They are back to posting solid profits, RM 150.9 million this quarter.
Yes, revenue is up, the tanks are full, and the downstream bleeding has finally stopped.
But the savvy listener needs to watch the quality of earnings. A huge chunk of this quarter's profit jump was thanks to the currency markets playing nice with their USD debt. It's paper profit, not necessarily cash in the wallet.
Correct. Don't mistake luck for genius.
Yeah.
But do recognize the operational stability. The business is fundamentally healthy again.
And looking forward, they are betting big on the green transition with new renewable storage capacity for Ecoeries coming online.
Which leads me to my final provocative thought for you to mull over.
Let's hear it.
Dialog has proven, beyond a shadow of a doubt, that they are the kings of storing crude oil. The world runs on oil right now, and the supply chains are mature and predictable. But as they pivot to renewable storage biofuels, sustainable aviation fuel, can they maintain those margins?
Oh, because it's a totally different market.
It is. The market for renewables is volatile. Supply chains are still forming. Regulations change every year. The moat is strong today because oil is king.
Huh.
But is the moat future-proof? Can they replicate that 25-year take-or-pay dominance in a green energy world where the rules haven't even been written yet? That is the real gamble of the next 5 years.
That is a fantastic point to end on. Just because you are the best at the old game doesn't automatically mean you win the new one.
Exactly.
Well, thank you so much for breaking that down for us. It is always a pleasure.
My pleasure entirely.
And to you, the listener, thank you for joining us on this update. If you found this breakdown of the Q2 turnaround helpful, please hit that like button.
It really does help.
It does. And we want to hear from you. Comment below. Do you trust the recovery? Or are you worried about those FX gains masking the real picture?
Let us know your thoughts.
Absolutely. Drop them in the comments. And don't forget to subscribe so you don't miss the next deep dive. Until next time.